Big news today, of course, is that the World Bank has approved Eskom's $3.75 billion loan, which will be used to co-finance the Medupi power plant in Limpopo. Joining us to chat about the implications of this is Jean-Francois Mercier. He's the chief economist at Citi South Africa. Jean-Francois, thanks for coming in this afternoon.
Thank you.
This is, of course, the World Bank's first major loan to South Africa since the end of apartheid in 1994. How significant is it that we got this loan?
Well, I think it is significant, although it was, well, I would say, a qualified endorsement. You know, I had some of the major members of the World Bank abstain and made it clear they abstained because there were environmental concerns. So, to a certain extent, the World Bank and its board members, which are the member countries, obviously are saying, yes, we lend you the money because we are aware of the importance this has to growth and poverty reduction, the need for generate more electricity, but it is a way of saying you should have done it better and thought of renewable energies earlier. Really, it was a qualified endorsement.
Should have thought of renewable energies earlier, which of course we didn't. At this stage, did we have any choice but to go for this coal-fired plant?
I don't think we have any choice. The other alternative to increase generating capacity fairly fast, by a large extent, is nuclear. And it would take longer to build a nuclear power station at a time when the needs are quite pressing. Medupi and even Kusile need to be completed within the next 2 to 5 years. Otherwise, we are going, come the middle of the decade, to face significant constraints. Supply would not just keep a pace with demand, assuming that demand grows at even at a relatively moderate to strong pace, not necessarily at a very strong pace. Yes, the mistakes have been done in the past, but you cannot just say South Africa has to suffer for years of mediocre potential growth because of the mistakes made in the past. The only way to get supply increased within 2 to 5 years is to complete Medupi and to build the Kusile power station.
Okay, so if we did face electricity constraints, if we didn't get Medupi up and running in time, you're saying that we would have had mediocre growth going forward. There would have been a knock-on effect on the whole economy.
I think if you have a supply constraint, the only way is either you adjust demand in view of the level of supply, which means that the economy does not grow as much as it could, unless, of course, the economy gets much more electricity intensive very quickly. But it's unlikely that such a structural adjustment can take place quickly. Probably for several years you would see a weaker growth, or we'd have to see a very strong price increase, which would also impede potential growth.
And of course, we know that energy-intensive sectors are already under pressure. We've had to cancel an aluminium smelter that was supposed to be built at Kucha. So already that focus is moving away from those energy-intensive sectors, Jean-Francois.
No, clearly the era of cheap and abundant electricity in South Africa is over. We can still have abundant electricity in the long run if the build program and then the shift towards renewable energies takes place at a proper pace, but it is not going to be cheap energy. The economy has to shift to a more knowledge-intensive and less commodity and energy-dependent model than it has had for the past decades, or even really for its existence, because the South African economy has always been based on abundant and cheap resources. The problem is that such a structural shift in the economy can only happen maybe over 10, 20 years. Considering the pressing needs for poverty reduction and the risk of social tensions that this poverty can occasion, we can't afford to waste another 20 years, have another 20 years of stagnating economy, just like the economy did stagnate in the 70s, 80s.
Well, the fact that we have got the loan now from the World Bank, what sort of signal do you think that sends to other potential financiers? I mean, do you think it'll be easier for us to raise the rest of the money? Because, of course, this amount is just a small amount compared to what we really need to build the Medupi and the other power stations.
It is a small amount, yes. It's less than 10% of the estimated total funding cost of Eskom up to 2013. But typically, in all countries, you always say, well, when you secure financing from the IMF and World Bank, then that opens the door for other financing. It's less a valid argument in the case of South Africa, because South Africa has a reasonably good credit rating, and foreign investors have not waited for the IMF or the World Bank to lend some money to South Africa to come in. We've seen it, for instance, with the issuance of the Treasury's international dollar bond about a month ago, that it was well subscribed to the point that the Treasury raised more than it was initially intending to raise. So South Africa has already reasonably good access to global capital markets, but from a symbolic point of view, it is still important.
Okay, the terms of this loan at 6-month LIBOR plus 0.5% fixed margin, variable spread of 0.24%, and this is to be reset semi-annually. How does that compare with what we could get perhaps in the bond market or elsewhere?
These are not bad terms. These are not bad terms. The terms that South Africa gets in the bond market is not too bad either. The sovereign spread on South Africa at the moment is the credit default swap spread, maybe of the order 140, 150 basis points, but it is potentially more volatile. At the end of the day, as I say, South Africa did not have a perceived credit worthiness problem because it has relatively low foreign debt, and that is why, whether it gets money through multilateral channels or through the market, it is not paying an extortionate price.